everyone. This is Avijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of June 15th, recording this in the morning of June 20th. So right up front, our blog site is at chartsarefun.substack.com. We publish daily blogs. Appreciate you subscribing to it. Just have to go to substack.com, the Chartsarefun, hit the subscribe button, and as soon as these blogs are published, they'll be emailed out to you. Our YouTube site is also Charts of Fun. We do believe there are tremendous fun insights in these charts. We don't provide investment advice. These are primarily to share some technical analysis, some fun patterns that we spot in the charts to kind of help you in your investment decisions. This week was a big week with the Kevin Warsh, his first FOMC chair as the chairman with his first press conference. That was on Wednesday afternoon. He did give some hawkish signals. He talked about unanimously the FOMC now is going to focus on price stability. As we know, the FOMC has two mandates, price stability and unemployment. They're not as worried about the employment picture as they are worried about price stability. We know that oil prices have been, pretty much coasting higher the last several months. He very clearly indicated that their goal is to bring inflation down to that 2% target. Now, he didn't explicitly say if it had to be exactly 2, it could effectively be a 2 handle. So a 2.75 or anything below 3% is what he was going to be trying to drive the inflation levels at. Currently, we know that the last couple of months of prints, inflation has been steadily above 4%. So the 2-year Treasury, we can see this right here, was a spiked higher from near 4.05% all the way to 4.22%. That bullish kind of, or bearish from the bond market, but bullish with respect to the yield. We can see that engulfing kind of a candle started off at the low, took off the last several. This is daily, so last several days of range and close towards the high. Thursday, Friday, the market was closed. Thursday, it pulled back a little bit, but overall, this is indicating that yields, especially the short-term yields, the 2-year yields, indicating that perhaps an interest rate hike is possible this year. They didn't do anything in this particular June meeting, but moving forward sometime in early fall, if inflation trends continue or price stability continues to be a concern, wouldn't be surprised to see some hikes, because if you look at where the Fed funds rate is, it's at least 50 to 75 basis points below where the 2-year yield is coasting at 4.2, anywhere between the 3.5 to 3.7% from a Fed funds rate perspective. So at least 50 basis points above. So 2 hikes in the next several months is quite possible. And 2 hikes could even come this year, given Fed's concerns about price stability. Now, a little longer perspective, the 10-year yield, and we've been watching this, we've shared this in the past, has a pattern of an inverse head and shoulder. This is the 10-year yield Treasury TNX. We can see the neckline at around 4.48, 4.5%. The left shoulder here at a 42.05 or 4.2%. 2 kind of double bottom kind of a head at 3.95%, 39.47, 39.56. So about 3.95% came back to that 4.48, 4.49. And then the right shoulder again at 42.2 or 4.22. And then that breakout, that measured target from this inverse head and shoulder is at 5.22%. We didn't quite get there. We got at the 46.87 and from there pulled back. But right now it is testing a key 50 period moving average at 4.42. It tested it twice. This could be a W-shaped pattern, and then a break higher is what we will be watching in the next few weeks. If this turns out to be a W-shape and higher yields, that could in some ways create a competition of money, especially safe haven chasers or people who are looking for risk-free investments instead of going into very expensive, extremely stretched out equity markets, start putting money, especially baby boomers and retirees, into treasuries, where from a safe haven perspective, generating decently good yield is what could be an opportunity for people. Now, if you take this is the daily chart. If you take the chart of the weekly shows us an interesting pattern again of the double bottom that I talked about at 3.95. These are the double bottom that we tested in 2025 and then in 2026. Now, if this at that 4.68 is the handle and then the breakout, That measured target from 39.56 to a 46.07. That measures close to 5.4%, 54 or 5.4%. So this is a broader cup at 46.29, two bases of the cup or two double bottoms at 3.95, 46.87. That measured cup and handle, if this is a shallow handle and then the breakout, measures lot had 5.4, and this is something will not be, I think, very friendly for the stock market. So that's something for us definitely to watch, and extremely correlated with this treasury yields creeping higher or breaking higher is the US dollar, because higher yields indicate money seeking into dollar investments, bringing in more dollar as a better currency to chase than yen or any of the other currencies. And this had a long-term base over the last 2 years. We can see that the USD, the dollar market basket currencies, have been between 100 to 95.55. That was the low. It is at the verge of breaking out of the base, and it did break out. So that 100.6, if you go back all the way across last 3 4 years, we can see that level of 100.16. We can see 100.8, 100.79 many times, which was tested as support, is now at resistance that it just broke out. 100.64 was the previous high in 2026. It broke out, and we can see that the high was 101.13. It dipped below it to close on Friday. Dollar was open. It did trade on Friday, though the stock market was closed on Friday. So we can see 19th June, which is yesterday, did trade. It did break. So this is the weekly chart, by the way, but it did touch 101 and then closed for the week at 100.76, which is above the previous high of 100.64. So this is the key barometer we will also be watching, because the dollar goes higher. This breakout from a 95 to a 100 is a 5-point breakout. A 5 to 100.64 measures to something around 105.7 or so. So that's potentially where we think dollar could climb. There will be, of course, some resistance at that 101.98 or 102 level. We can see that this is also the 200 period moving average at that 102.87. So at that 102, 103, there could be some initial resistance, but that measured breakout from this base is at 105, 106 is where we think dollar could climb. Now, what happens when a dollar strengthens? It immediately has a negative impact on emerging markets. So let's look at the MSCI Emerging Market ETF, EEM. This is flagging a bearish pattern called a rising wedge. If you join the higher highs, join the higher lows, this is converging to an apex. That's what a bearish rising wedge pattern looks like. And when it's validated with negative divergence, as in lower highs in RSI, this is a topping pattern. So whatever one does, I would be very careful investing. We would suggest be careful investing into emerging markets. This is showing topping signs, indicates in particular the aggressive emerging markets. And let's show you one. South Korea, look at this massive climb that it has had on the back of higher memory prices, incredible performance of the memory related companies such as Micron, SanDisk, and two of the strongest and the biggest companies of memory in South Korea's index. This is what they call as the Kospi index, is Hynix Semiconductor and Samsung. That has been causing massive climb in the South Korea MSCI ETF EWY, related to, of course, the Kospi index. Classic negative divergence in RSI as we form again a bearish rising wedge pattern. Be very careful in the memory stocks. Be very careful investing in South Korea as the emerging market that could perhaps have the biggest drop, is what we are cautioning on. And look at the parabolic climb. Look at the vertical climb that we've had, with that negative divergence on the weekly chart indicating at the minimum a pullback from where it is at 219. It closed last week at the minimum, close to the lower end of the rising wedge at 200, break below it, and I wouldn't be surprised for it to come back towards the 150s is where at the minimum, or even more. Another hot sector has been the semiconductor. We know that. And the iShares semiconductor ETF SOXX, SOXX, has been rising along a steep rising channel. This is not a bearish rising wedge, but a rising channel. We can see it's a very narrow channel, but a steep slope and a steep climb. It ended at the top end of the channel with negative divergence on its RSI. slightly lower high as it's printing higher highs is how negative divergence forms. Wouldn't be surprised for this to break down in the next month or two. July, August into September, even a bottom into October, the next 3, 4 months, be very careful on a sharp pullback on the semiconductor industry. This kind of capitulation peak in volume when it's hitting its peak to us are signs where typically from where we could start seeing the pullback. So that's something for us to be very careful about. Along to the semiconductor has been the NASDAQ 100, the QQQ, similar kind of a vertical climb. It had broken down the week before, fell below the bottom end of the rising channel. So that was almost like a warning that, look, if it does break down, what could happen? So that warning came. It came back to retest that highs near 748, 750. On the weekly chart, RSI is showing a lower high, again, a negative divergence. Be careful. This potentially from a 748 to a 686, we're talking about 62 points. Subtract 62 from 686, 624. We are seeing that the rising 50 period moving average are at 617, but that's rising. So that could be rising to the 624 level by the time this drop happens. So we are watching for a QQQ drop to a 624, the SOXX, that could have a very sharp drop, and the South Korea EWI, all leading to a technology kind of a sell-off coming. Now, one sector in the technology that seems quite attractive for a bounce, that's the software sector. It had had a very strong May. The last part of May, it vertically climbed when it broke above a key resistance level at 88, 89 to 108, pullback, 3 successive weeks of pullback. Volume is declining, lower highs in volume as it's declining. Guess what it's testing? A very key support level. Support level from that horizontal support at that 88. We can see it has tested what was resistance in 2024 and what was resistance in the more recent 2026 climb is now support at that 87, 88 level. And then if you join the declining trend line from those tops from late 2025, that's meeting right at that intersection point at 87, 88 is where we close. We close right at 88, in fact, 89.09. That's hammered. Microsoft in particular has been literally hammered bad. That's the leading one of the components of IGV, the software ETF. There are others like Palantir, there are Oracle. So there are a bunch of other software plays that have all been hammered. If this could be a contrarian play with respect to an opportunistic buy. That said, if you look at the bearish view of IGV, that paints a very bearish picture. And that would mean potentially that if this turns out to be a head and shoulder pattern instead, as in a total crumble of the software sector, then Microsoft is going a lot lower because Microsoft is the key holding of this. Software stocks are going a lot lower. We don't feel that's quite going to happen, but there are folks who are painting a very bearish picture on IGV and can't deny that. 74.75 is the neckline. We can see the left shoulder from there to 110, pull back to that 75, the head to 118, pull back to that 75. Right shoulder is slightly below the left shoulder, 110 to 108. If this breaks down, you're measuring from a 75 to 118 or 117, that's like $42. Subtract 42 from 75, you're talking about 32 to 33. Potentially is where this measured downside is if we get. That would be a significant sell-off in software stocks if we have IGV has to break down from this head and shoulder pattern. We feel more likely this is a contrarian buying opportunity in software. We feel that this support line, because of two key convergences of support from the declining tops line here, trend line, and then the horizontal support line, is going to hold because they're quite washed out in the software stocks and expect a counter trend rise at least. Then from there, we have to watch because remember, two key AI companies are coming next after SpaceX. SpaceX IPO was the previous week. Coming ahead in the next couple of months, we have two kings of AI in terms of software, Anthropic and OpenAI, two of the largest, both very close to $1 trillion in valuation. But once their IPO comes out, like we saw with SpaceX, IPO came out at 1.8 trillion, quickly jumped in valuation to 2.2, 2.5 trillion. So similar kind of upward move with speculative buying of OpenAI and Anthropic could lead even their market cap past $1 trillion. But that could, they are potentially index additions to IGV because they are software companies. Of course, they will be added to the AI ETFs and so on, but from an iShares perspective, IGV is a software index, and these are software companies. So if IGV gets OpenAI and Anthropic in its index, this could cause IGV to climb, is what we are potentially thinking about, which in this case, this is a golden buying opportunity on IGV because IGV, if it turns out not that bearish pattern, but this bullish breakout from a 74 to a 108, you're talking about 34 added to 108, 142 is where IGV could break above 118 and go to 142. And that could be powered by these two big AI IPOs. So that's something for us to think about. We don't know for sure because they haven't announced if OpenAI and Anthropic will be considered in IGV, but at the end, they are software companies, and it's a potential possibility they could come in with very high weights if they get added to this sector for us or to this ETF for us to look into. Good luck investing. We'll talk to you next week. Thank you so much.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.